There are a multitude of risks that markets are attempting to digest at present. We've got continuing political instability, energy price shocks, and underwhelming economic prospects now in a number of regions that are clearly weighing on markets. In our view, will continue to be a source of uncertainty and volatility in markets. On the subject of energy, it's our view that oil will continue to dominate the headlines in the near term. From a peak of $115 a barrel in the middle of last year, crude's collapsed to $55 a barrel at year-end, and has resulted in its biggest annual decline in 6 years. I think with the present supply and demand imbalances, and without a significant supply response from OPEC, which I feel is unlikely at this point, prices could remain depressed for some time. It's certainly feasible, I think, that oil tests that mid to lower end of the $40 a barrel mark as we enter a period of weak seasonal demand. I suspect we could also see oil remain under $80 a barrel for the next 2 to 3 years, although it's reasonable to expect some sort of recovery to around $70 a barrel by year-end. But the rapid fall in oil has disproportionately and adversely impacted the valuations of many energy sector companies. I think it presents a great opportunity to acquire good companies with strong franchises at discounted valuations. Our deep value global equity managers should be well positioned to capitalize on these opportunities. Turning to bond markets, yet again, bond markets have exceeded the expectations of many, including ourselves. We've had another year of strong returns from developed government bond markets over 2014. But we're on the cusp of a year now where we should start to see divergent interest rate policies from the major central banks for the first time since the financial crisis. While the proposition of increasing interest rates in the US could finally put some pressure on the US Treasury market, we expect to see continued support for other government bonds in the coming months, particularly with the looming prospect of full-scale quantitative easing by the European Central Bank as it battles to avoid deflation within the region. Now, pockets of opportunities are emerging in a number of markets. But I think when it comes to assessing the value of different asset classes, the risks inherent in our valuation models and projections, it's that impact on the outlook for oil that's becoming increasingly relevant. I think it's particularly true for the US high-yield sector, where the broader energy sector now accounts for roughly 16% of the overall US high-yield market, having been a very large issuer over the past 5 years. But despite the uncertainty on the direction of the oil price in the short term, I think that the valuations of high-yielding corporate credit in aggregate are beginning to appear attractive. Our assessment is that the current market environment provides good opportunities for good active managers to generate returns. But position sizing remains important. I think, in our view, requires an experienced active manager to be able to navigate the risks. Having sold out of our high-yield credit positions in the first half of last year, we returned to the asset class in the final quarter of 2014. It was that spike in credit spreads in October that was a catalyst to initiate a 5% position in short-duration high-yield. And it was that further sell-off in high-yield in mid-December that saw us take an additional 5% position, but this time in the full-duration high-yield. So overall, high-yield spreads, the additional yield over treasuries, have increased meaningfully over the year, from a low of around 3.2% to a mid-December high of 5.5%. Now, at present, we've got around a third of our fund exposed to equity markets, with around 7.5% of the total portfolio in emerging equity markets. We've increased our exposure to UK equities by 5% over the past quarter. Having lagged its developed market peers and following a 10% correction from its September peak, I think the valuation of UK equities is sufficiently good to warrant a position in this market. Now, both that high yield and the UK equity position was in part funded from cash, but also in part by reducing exposure to European mortgage-backed securities and global listed infrastructure, the latter having outperformed global equities by 15% over 2014. The UK equity market, with its large resource component, contracted by 0.4% over the final quarter of 2014, bringing its full calendar year return to just 0.5%, making it one of the weakest performing equity markets. Outside of the UK, and despite the drag from a falling oil price, global equities performed much better, returning 3.5% for the quarter, and 10.5% for the year hedged back to sterling. Against this backdrop, our diversified target return fund returned 0.8% over the fourth quarter and 3.3% over the whole of 2014. Now, our asset allocation decisions clearly dominated returns over both the quarter and the full year. Over the quarter, it was our allocation to global, quality, and our well-timed entry into UK equities that generated the performance. Over the full year, it was a broader mix of both equity and fixed income asset classes that drove performance. Now, from a manager selection perspective, the managers we use to gain exposure to global equity markets really struggle against the broad market, and they proved a drag on performance. I think active global equity managers in general experienced a very difficult 2014. There are probably a number of factors that likely contributed to this outcome. It was the strong performance of the US dollar and the US stock market, the largest component of the universe. The fact that larger cap stocks outperformed smaller capitalization stocks. And the concentrated nature of returns in the index this year. The fact that IT and healthcare contributed almost 80% of the index returns, despite accounting for less than half of the index, certainly contributing factors. As we've said for a while now, a degree of caution remains appropriate. We're running with a moderately low level of overall risk in the DTR portfolio. We're maintaining a moderate position in equity, and we continue to hold a reasonable amount of the overall portfolio risk in emerging market assets, both equity and debt. It's actually a position we've held for much of 2014. Finally, we'd expect to see bursts of volatility return to markets, so position sizing and risk management will continue to be of the utmost importance. And as always, we'll retain a healthy level of diversification in the portfolio.